All right, well, welcome to chapter 22, where we talk about disclosure and measurement to primarily. So, full disclosures. The idea is, what is meant by full disclosure? What is included in the financial statements and what is included in other documents? So this is an area that you have to look at what is required under audit to be disclosed as a note versus what is additional information that management might want to present in an annual report or otherwise. So what's required is under GAAP, you need to report any financial facts that are significant enough to influence potential judgment of any reader. So somebody that might look at your financial statement and might require additional information to maybe better understand the information or make an appropriate decision. Disclosure over the last decade or so has increased substantially. The financial environment's more complex, investors are getting more knowledgeable, information hopefully has become more timely, and there's more monitoring done by various bodies. So there's an increased importance to disclose what's happening in your organization. First category we'll talk about is related party transactions. This is a transaction in the business where one of the parties of the transaction has the ability to significantly influence the policies of the other. So it could be as simple as providing payments to a board member of your organization. If those payments are set by policy by the board, well, that's related because they can determine their own compensation perhaps. So that's kind of the first bullet. Companies are individuals who are controlled by that reporting enterprise. And wherever there's significant influence or joint control, so maybe it's corporate to corporate, one entity to another. Maybe it's the management of the company. Maybe it's immediate family members of the board or company leadership. And this also you have to look at, can business be carried out at arm's length or not? And that will help you determine whether it's a related party activity. So how are they reported? Under disclosures, you are required then to describe the nature of the relationship. So they are a board member or the spouse of the president, and they own a business that provides catering services, and they were hired for every event. Related party. What's the description of that transaction? What's the amount? What's the measurement basis? How was it ensured that we paid them appropriately? What are the amounts due to and from that related party? What are any contracts? What are any contingencies with those related parties? And what's the management compensation or the name of any entity's parent company? So when there's related parties that go between companies, you want to have that disclosed as well. ASPE has additional guidelines for any transactions that aren't normal for the business, and there's independent evidence to support that transaction. Those transactions are then remeasured at the carrying amount of the assets. For any transactions in the normal course of business that lack commercial substance, no gain or loss should be recognized. So if there's a transaction that had a gain or loss and it's a related party, you would have to adjust your entry accordingly. And that difference would be an adjustment to contributed surplus or retained earnings. So either reduce retained earnings or increase the contributed surplus if there is a gain or loss. Talking about subsequent events. So subsequent events are items that happen between the balance sheet date and the date that the financial statements are completed. So very often you say you have a financial statement date March 31st, but it might take you till June 10th to get those financial statements out. So subsequent events would look at the activities between those two dates. And those events would be disclosed in the cases where that evidence would provide additional information that would help or that would impact estimates in preparing financial statements, and would then typically require adjustments. So say you had a bonus accrual at year end based on policy, but then 5 weeks after year end, something happened and you found out that there would be no bonus. So you should, revise the estimates accordingly because of a subsequent event. Any event that provide evidence that, that something exists today that you didn't know of as of the balance sheet. Maybe it's a lawsuit that came in April, but it has to do with activities in January. You would also disclose that and require adjustments accordingly. Here's an example. Customer that owes money goes bankrupt. So an AR that maybe you didn't allow for, and you have insignificant allowance for doubtful accounts, that would be considered a subsequent event, and you would have to adjust accordingly. Maybe you had a fire or flood, or maybe there's a significant market value of an investment. So you had $1 million investment in company A, and company A just closed up shop. You lost that $1 million. You need to report that as a subsequent event and adjust. Maybe you purchased a business. Maybe there's some legal action. Maybe there's a significant change in currency rates. The things like that you need to look at. Moving on to auditors' reports. So an unqualified opinion, this kind of sounds funny. Unqualified means clean. That's a good thing. That's what you want as an internal accountant. Unqualified means they present fairly the situation in conformity with GAAP. Qualified means kind of, except for something. So they would say qualified opinion subject to, maybe the company didn't adopt a proper accounting policy under GAAP, whatever that might be. Maybe they'll have a disclaimer of opinion, which means they had insufficient information to give an opinion. Or lastly, an adverse opinion, which is bad, which means your financial statements are not presented in accordance with GAAP. So they do not support those financial statements. Moving on to other areas of your notes, segment reporting. So segment means you might have multiple divisions of an organization that readers of your financial statements would benefit by having additional information in your notes split out by those segments or reporting divisions. It helps understand that the enterprise's performance, where they're making money or losing money. It helps better understand or assess its future net cash flows. It might help the readers make more informed decisions or judgments about the enterprise. And so typically the requirement is by segment is disclosing by operating segment of the chief operating decision makers. So maybe you have a senior manager, responsible for, say, personal insurance, and you have one for commercial insurance, and you're a big insurance company. So maybe you report, the profits and losses of the personal division separate from the commercial division, because maybe they have different bonus structures or different investment algorithms, whatever that might be. And that's only under IFRS that it's required. As far as the definition of the operating segment, it's any component of the organization that engages in business activities, that it earns revenues and incurs expenses. Any segments are part of the organization where those operating results are reviewed regularly, and where there's discrete financial information available on it. Okay. You can combine information about two or more together if they have the same basic characteristics. So you don't have to split it all up if they're very similar components or segments of the business. So under your note disclosures, then you would provide some general information about those segments. You would provide, what's the revenue, what's the expenses, any assets or liabilities that are specific to those segments. You would provide a reconciliation or a table of that segmented revenue, profit, loss, et cetera, back to the total on the financial statement. So typically you would do a chart or a table in your notes that perhaps have the different segments, and then you'll have a total, and the total column would tie to your statement of financial activities or your income statement. You could identify, your products and services revenue from external customers versus internal. And if there's foreign information, it must be disclosed by country if material. And any major customers. So say you had 5 big customers, well, or in maybe 500 little ones, those 5 big ones, if they're, say, generating 90% of your revenue, you probably want to disclose the revenue from those customers, because if one goes under, significant impact on your operations. So as far as what is considered significant, if reporting revenue is 10% or more, considered reportable. Or if the absolute amount, so removing the negative sign of the loss, if the absolute amount of its reported profit or loss is 10% or more of the greater of the total of all profitable segments or the total of all unprofitable segments. And the third test is if the assets are 10% or more of the enterprise total assets. Also, the last thing is you want to provide enough segmented data to give at least 75% of the enterprise's total sales, but no more than 10 should be presented. Okay, so it just gives you an idea of how big should some of these tables be. So hopefully you found little tidbits of information today. Take care.